I've been day trading for 7 years and I have perfected how to enter a profitable trade the right way. I've tested hundreds of strategies and concepts, including price action, liquidity, market structure, and after years of losing money on complicated strategies, I have simplified my entry model into 3 simple steps that I use every time. In this video, I'm going to explain the 3 most important concepts that build up the foundation for any profitable trading strategy. And then I'll show real trading examples using these concepts so you can see it work in real time. So in this video, I want to share the exact 3 steps I use to enter high probability trades. And you can see my personal performance for the last week. This is a regulated broker, but one of the most important things I want you to understand is you see 1 week of good results. But to get these results, it took 7 years of learning and perfecting my trading. This did not happen overnight, and trading is not a get-rich-quick business. With this being said, one thing that we can do to increase our probability of seeing profitability is making trading simple. And for me, I always preach simplicity equals profitability if you do it the right way. When I trade, I have a very simple approach. And this way, if you're a beginner trader or an advanced trader, we can use simplicity for profitability. Now, with this being said, every time I enter a trade, I use the same 3-step entry model for high probability entries. The best part is no matter what strategy, market, or time frame I trade, these steps will still help me get higher probability entries. So first, I will explain all 3 of these steps, and then I will show you real examples using these steps on the real chart so you can see exactly how I implement this in my trading. So here we have step 1. For step 1, all we need to do is identify the key levels. These are going to be the high probability zones that I want to focus on. Now, for me to have a repeatable and consistent system, I use the same levels every day. These levels consist of the previous day high and the previous day low, pre-market high and pre-market low, and finally, because this day hasn't opened yet, I will use the 15-minute or the 5-minute opening range high and low. These are all the levels that I use for the day, and these are going to be the high probability areas that I'm going to look for an entry off of. So if we take that previous chart example and actually play out the day, well, you can see we actually had the first 5-minute low down here and the 5-minute high up here. These areas are very close to the pre-market high and the pre-market low. Therefore, there's no need to draw them out, as I would just have too much noise on the chart. Like I said, we want to keep trading extremely simple. And then you can see we not only rejected up here of the pre-market high, you can see these lines up top here. These are called upper wicks. And all this means is sellers stepped up and therefore the market then headed down. You can see we then bounced off the pre-market low. And what are we doing? We are now retesting this red line. And we know this red line because we only use the same levels every day equals the previous day low. So when we see the break below the red line and now we are coming back for the retest, we know this is going to be a higher probability entry. And here we can see if we entered in with the weak price action off the previous day low, this trade worked out extremely nicely. We got low of day and even continuation after that, right off that previous day low level with tight risk, but a good reward, which means the risk to reward on this trade was good based off just key levels. But here's the problem. Just key levels is not enough. If it was as simple as drawing the same key levels every day and entering high probability trades, there would be more successful traders. And therefore, step 1 is to draw key levels so we know where the high probability zones are. But step 2 and 3 will help us confirm how to enter properly off of these key levels. All right, so for step 2, the next thing we have to do is observe price action. So like I talked about in the last step, we use the same key levels every day. And in this example, you can see the pre-market low level that we're using. You can see on this pre-market low level, we actually got the break below the pre-market low, and now we're coming back up for the retest of the pre-market low level for a move to the downside. Based off of this, we know from the previous step that these areas are high probability entry areas, but we also know that they're not telling us all the information. So if we were to take this trade short based off of this previous candle right here, you can see this trade actually moved to the upside and we would have stopped out of this trade or lost lost this trade. Now, because we lost this trade, but we understand from step one that this was a high probability entry area, what went wrong? How can we fix this for next time? And how can we have an even higher probability chance of entering quality trades while also confirming price action? Well, the reason this happened is because you don't understand price action yet. And therefore, you need to learn how a candlestick forms to get high probability entries. So when we're looking at a candlestick, on the left side here, this is a green candlestick. What this means is the stock wants to move to the upside, whereas on the right side here, this is a bearish candlestick. You can see this is red, and this simply indicates that the stock wants to move to the downside. Now, when we look at these candlesticks, we need to understand how they form. So let me simplify exactly how to read price action. First, let's do the bullish candle. So the bullish candle will open up near the body low. The body of a candle simply refers to the shaded area. So all the shaded area that you see is green. This is called the body of the candle. And then once again, these lines up here and down here, these are referred to as the wicks of the candle. So we can see the open of the bullish candlestick is always going to be at the low of the body. And what does this indicate? Well, from the previous candle, let's just assume the previous candle closed here. That means the next candle will close right where the previous candle closed. With this open, you can see we then created this wick. Well, this simply means at one point from this open, this candlestick was actually a red candle. So if you imagine the candlestick opening here, at one point before this candlestick fully closed, this was a bearish candle with a full down close or red body. However, from this area, buyers then decided to step up and overpower sellers. And when this happened, you can see this moved all the way back up to the high here. And then from this high, sellers then decided to step in and overpower buyers again. And therefore we closed right here. So in summary, you can see for the bullish candle, the body always has to close above the opening price. And then the wicks are simply telling you where buyers were overpowering sellers and then where sellers were overpowering buyers. And this is the most simple way to read price action in candlesticks. Vice versa, for a bearish candle, you can see the bearish candle or a down close candle will open at the high of the body. So this is going to be the high of the body here. At one point, we know that this candlestick was actually a fully bullish and green candlestick. However, after this, sellers then decided to step in and they moved the stock all the way down to the lows right here. This is where buyers once again stepped in to overpower sellers and then close the candlestick at the low of the body. So when you're reading charts, this is the most simple way to read price action and candlesticks. If you don't fully understand price action just yet, I have a full in-depth playlist going over everything you need to know to learn trading from scratch as a beginner. That playlist is absolutely free and it's going to be in the link in the description, so you can watch that full 10-hour playlist after you're done watching this video. So now that we do understand price action, let's go back to the trade that we were looking at previously. What happened and why did we lose this trade? Well, if we actually focus in on this trade, what ended up happening? Well, we saw within the first 3 candles, sellers were aggressive trying to move the stock to the downside. However, then we started getting these lower wicks, and these lower wicks started telling us that buyers may be overpowering sellers. And this green candle right here was a very strong indication that buyers are now starting to step in. And then on the candle that we actually entered on, this candle had a very strong bullish candle close above the pre-market low. So the problem here was we entered in on a candle that closed above the pre-market low, not below. So for a short entry, we need the candles to close below. For a long entry, we need the candle to close above. But for the short entry, we see that the body of this candle closed above the key level. Therefore, this actually indicated to us that buyers were once again overpowering sellers. But because we entered, we ended up losing this trade because we didn't understand price action before this step. So now that we do understand price action, what's the next step? So for step 3, this was the exact step that personally helped me increase my win rate. And this is waiting for confirmation on entry. Now, you may be asking yourself, we just talked about price action, we talked about key levels, but what does waiting for confirmation on an entry truly mean? Well, to answer that question, because we are in step 3 in the video and we've talked about the previous 2 steps, which trade do you think is a better trade for a short entry, meaning for the downside? So with option 1 here, we can see we have a very clear previous resistance. We then broke below. We are coming back for the retest. Now, we already talked about price action and what to look for. So based off the previous 2 steps, would you rather take this for a move to the downside? Or if we move over here, we have that clear support, which now turned into resistance because we broke below. We're retesting, and then we're also getting weak price action here as well. Which trade out of both of these would you want to trade for the downside? In the comments down below, to test your trading knowledge, put either option 1 or option 2 on which trade you think has a higher probability chance for the downside. Now, if we end up playing both trades out, you can see it was the clear winner and actually failed and moved all the way back to the upside, whereas had a very nice low of day move, and this is exactly what we want. Now, the question is, why did option 1 win? There's a couple reasons why this option 1 compared to option 2. So the first reason we have here is stronger confirmation. As we can see with this trade, there was not a single candle that broke back above the key level. Along with this, we can see weak price action, showing that sellers stepped in every single time we came near that resistance area. Therefore, this already shows us that every time we came into this area compared to option 2, sellers were much more aggressive than buyers, making this a little bit more higher probability. The second reason it won was because it had a clear downtrend with the flat bottom. So this is where you have to understand market structure. If you don't understand market structure, we're going to talk a little bit more about it when we get into the examples, but you can see we have a high up here. We then create a low. We create a lower high from the previous high, showing that the stock is in a downtrend. And once again, we create another low, showing that this stock has lower lows on the downside and it has lower highs every time as we come down as well. Number 3, we can see the retest of the flat bottom. So first we broke below this technical support level and then we retested, which both entries had. However, this one just had more of a clear example. And finally, the candle showed sellers were holding stock below, and then we entered on confirmation. So now we just went through the 3 steps on how to have higher probability entries. We talked about identifying key levels, observing price action, and most importantly, waiting for confirmation. However, so far I've only explained these steps. Now we're going to go to the more important part of the video, which is going to show these steps working with real trading examples. And this will allow us to see how to truly use these 3 steps for more higher probability entries. All right, so here we are on the first trade. Now this trade is on Tesla, and all we have to do for the first step is mark out the same repeatable levels every single day. The first level we're going to draw out is going to be the previous day high, and this is of course followed with the pre-market high as well. Then we're going to draw out the previous day low, and we're going to draw out the pre-market low. So going into the day before the market opens, which is at 9:30 a.m. Eastern time, we mark out the previous day high, the previous day low, the pre-market high, and the pre-market low. Previous day high and low happens from 9:30 a.m. Eastern to 4 p.m. Eastern, and the pre-market high and low happens from 4 a.m. Eastern to 9:29 a.m. Eastern. Now, coming into the day, all we want is to see our setup form. This is going to be a break above, a retest, and then continuation to either the upside or to the downside. The only levels we have left to draw out for the first step is going to be the 5-minute or the 15-minute opening range. However, once this trade actually plays out, then we can draw those levels as well. Let's play out this trade and let's see exactly what happens. You can see right off the bat, very, very strong price action. You can see buyers actually stepped in very aggressively here. We broke above the pre-market high, and now we also broke above the previous day high as well. Not only did we break above the previous day high, but what's happening here? We are currently coming back for the retest here of the previous day high. So very strong price action, buyers stepping in, and then the retest. Now, based off of this retest, we don't really have to draw out the 5-minute high and low anymore because this is the retest that we would be looking for an entry. But now what we need to do is observe the next 2 steps. So the second step is to understand price action. Well, here we can see buyers, of course, brought the stock up. Sellers came in, 3 red candles. However, on this candle right here, we can see the candle opened up at the top, then sellers brought it all the way down. However, buyers brought it back above the previous day high and closed it as a strong candle. Third step is waiting for that candle to close above the level And we can see that this candle, of course, closed above the previous day high. So this is actually somewhere we can look to enter a long position, as this aligns with the high probability entry. Our stop loss can simply be a break below the candle that we're entering on, because we know buyers want to hold the stock not only above the previous day high, but above this down close candle. This is where buyers stepped in to overpower sellers, and we need at least a 2R multiple. All a 2R multiple means is for every $100 of risk, we need to make $200 of profit. In this example, high of day gives us a 2.51 risk multiple. Therefore, let's enter into a trade here and let's see exactly what happens. Once again, you can see our profit factor, if we win this trade, is $4,350. And if we lose this trade, we lose $1,860. And just like that, you can see this trade worked out extremely nicely. A move to the upside, buyers stepped in, and then that nice aggressive move all the way back up into high of day. This was a bullish example on Tesla. I'm going to show you a bearish example next. And though this example is of course hindsight, because I'm trying to explain the concept to you, this example was taken live in the accelerator where I live trade every single day. Point of that is not for alerts or signals, but it's to show you that these concepts do work in real time and to help you practice these concepts in real time and implement it on the chart. So this was the first bullish trade, but now let's go over to a bearish example. All right, so here we are on the second example. This is going to be the bearish example using these 3 steps to enter high probability trades. And we're going to repeat these 3 steps repeatably every time because they're so simple to follow. The first step is simply to mark out the previous day low. Once again, this happens until 4 p.m. Eastern. Therefore, this part right here is just going to be the after hours. And then we're going to mark out the pre-market low, but you can see the pre-market low is very aligned with already the previous day low. So we don't have to draw that level out just because it is so close to the previous day low already. And now we can draw out the previous day high and of course the pre-market high as well. And now all we have to do is wait for the stock to open up in the day, wait for the first 5 minutes, because we see that in the first 5 minutes, the stock did not actually end up breaking and retesting anything. And therefore we can now draw out the 5-minute high up here and we can draw out the 5-minute low down here. Now, if you don't know when to use a 5-minute first candle strategy compared to the 15-minute first candle strategy, which I have a full in-depth video in the playlist down below, like I said, if you don't know how to use it, I'm going to be making a full guide explaining the difference between the 5-minute and the 15-minute and when to use them for the most optimal entries. That video will come out soon. But with that being said, now what we have to do is simply wait for the stock to break and retest a specific level. So right now we can see we're still in the range of the 5-minute high and the 5-minute low. You can actually see some sellers stepping in right above here. This is where the sellers actually ended up stepping in. And now you can see after we rejected this, we made a brand new low, breaking the 5-minute low. But what's going on right here? Well, now we're actually getting that retest of the 5-minute low. So let's see if we can get a proper entry. Now on the retest, what do we see? Well, we see that we were in this 5-minute range first, then we broke the low. So this is a high probability entry based off the key level. The second step is understanding price action. We can see every time we came up above the 5-minute range here, the buyers try to bring it up, but sellers were very aggressive, as we can see on the last 3 upper wick candles. This signifies sellers are overpowering buyers. And for the third step, we need to wait for the candle closure. And in this example, we can see every single body candle closure was below the 5-minute range low. This is a good short position, so we can enter into a short position here. Our stop loss, once again, just being a break back above the candle that we're entering on. In this example, that 2R multiple comes right at that 202 whole psychological number. So let's enter into a short position here. In this example, we're risking about $300 to make $560, and let's see exactly what happens. And just like that, you can see we were done the day at 9:56, meaning about 30 minutes. And this is exactly how I enter into trades whenever I'm looking for a high probability entry. With this being said, if you want more information on market structure, price action, liquidity, strategy, or any trading related education, make sure to click the playlist. It's filled with value and it's absolutely free. If this video helped you, make sure to leave it a like. If you have any questions, put them in the comments down below. Make sure to subscribe to the channel, follow me on Instagram and Twitter for more education, and I will see you next week with a brand new video.